Hey, welcome back. This is Mr. Market. Thank you so much for joining me. We're now into our 10th episode, and also to celebrate, we also reached our 100th subscriber. So thank you all for joining me and watching me throughout this whole time. It's been a nice journey for the past few months. Speaking of the past, this past week, the stock market had it pretty rough. We had the worst week in the stock market of 2023. The market fell 2.67%. And this was on the heels of some hot inflation numbers. The market is really starting to get worried that the Federal Reserve will have to raise interest rates to the point where they'll have to tip the market into a recession in order to bring inflation back down to the 2% level. And it's going to take a lot of work. There's been some research from some other Federal Reserve economists who think that there is no way out of this situation unless the Federal Reserve puts the economy into a recession. So to recap, how did we do? Well, the market had a pretty rough week, but guess what? We made money. We were actually up $214 for the week. Yeah, it's not a lot, but in the context of a rough week, I'll take it. Our year-to-date gain is $13,475. Our approach continues to impress me. The algorithm is doing a great job of identifying where the markets are turning, where the risks are rising, and it's allowed us to go position our bet sizes accordingly. So for this past week, we had we sold some calls that allowed us to go make some money in this falling market, and it was that hedge that was primarily responsible for generating some profits this week. I did have some puts at the $395 level, and again, just like last week, the market dipped right below it, and so I had to roll down my strike prices and give up some of my profit. And right after I did that, of course, the market bounced back. So it's a little bit frustrating, but that's how markets go. But as long as I'm able to eke out a profit, I'm not going to be complaining too badly, especially when the markets are having a rough week. So with the market falling this past week, it closed below the 50-day moving average, which is a really important technical level for a lot of traders. One thing that I've noticed is that it changes the sentiment pretty significantly from positive to negative. And when you get the market to fall below that level, the dip buyers end up kind of capitulating, and then they end up becoming more sellers on the rallies. So this week is going to be really important. We need to see if the market will bounce above the 50-day average or stay above the 200-day average. And if it falls below it, I think you're going to start seeing some more selling and some more bad news come out, because one thing I've noticed is that price creates the sentiment. It creates the narrative. It's a confirmation bias seeking mechanism. So when the markets have fallen, you start seeing the market, the media, they start looking for reasons for why the market will keep falling, why things are negative. And if the market's rising, then you start to see the media get more positive and look for more reasons for why the market can keep rising. So it's a mechanism that has inertia, and that's what makes me think that the market, it kind of follows Newton's first law of motion. An object in motion will stay in motion unless it's acted upon by another external force. So right now the market is in a downtrend, and I think it's really important not to try to go fight it, not try to pick bottoms. I've tried it so many times over my long career that I put a post-it note to myself to remind myself the trap is when you think something has gone too high or too low. And that is a reminder for me to not try to pick the bottoms, because it has been hazardous to my wealth. I have found that it's been far better to go wait until a move has exhausted itself and that downtrend or uptrend has broken before I act upon it. So I think that's what I'm going to be doing here before I try to get more aggressive with my bet sizes. And one other thing that we need to keep track of is the change in the money supply. Not a lot of people talk about it as much as the inflation or as much as earnings, but the money supply growth or its contraction actually plays a really strong role in stock prices. I saw this research report on Seeking Alpha some months back, and they ran a linear regression on how the money supply affects stock prices, and they found that it has about like an 8-month lag, and it had like an R squared of like 98%. And so, as long as the money supply is contracting, it's a good idea to try to not fight that trend. And until that direction in money supply changes, I think it makes a lot of sense to be cautious. So, where do I think stock prices can go? If we take a look at the relationship between the 10-year bond yield and where the S&P 500 is, this is a crude tool that I'm using right now, but if you take a look at where the market was when bond rates were at this level, the downside target could be about $380 for the S&P 500. That would be my crude valuation measure for where stocks can go, and that's where I think it could be more at a fair value level. So, with that said, I put my strike prices for this upcoming week to $385 because I think there's a lot more support at that level. There's some more congestion, and you're going to get a lot of dip buyers that are going to want to come in at that level. And also, I also have some calls at the $410 strike price in case the market continues to fall. So that's all I've got for this week. I know it was pretty rough for the market last week, but one interesting tidbit that we've got is that some of the best returns that we have typically happen after our worst returns. So, maybe we'll get a bounce. No idea. But, good luck to you. Good luck to me. Good luck to us. And, please click like and subscribe. And I will see you next week.